So we're going to see how far along we are on this trajectory towards the next housing crash. We're going to go over some data now and have a look at what exactly is going on. So let's just start with the National Home Price Index, CaseShiller Home Price Index. We're using the FRED. As always, this is the data from the Federal Reserve, and we're at 219.8 at the moment. And you can see these wavy lines. I'll explain what these means shortly, but these are just seasonal adjustments in the housing market. And here we are. So if we go back to where we had the peak for the 2008 crisis, we hit around the 184 mark, 1884.5, before we started to go down, during this crisis, before we really hit a bottom of about 134 approximately. So just bear this in mind, 184.5, and we are already way past that this time. And I know it was a completely different crash back then. It was due to the shadow banking sector, a lot of bad loans that were made, but still, we've still got to look at this data and take it bit by bit in order to create the whole. So here it was, December 2016 is when we passed the peak of the last housing crash, the peak of the pricing before we went into the crash. And look where we are now. We have just been going on a long run. We're at 200, almost 220 as it stands today, which is extremely high. We are in bubble territory now. I know I get criticized a lot for what my data and my predictions, but we are in bubble territory. There is no possible way that we are going to be going into this boom for the next few years. This is coming down, and it's going to be coming down very, very quickly. So let's just look at a little bit of data here then. So firstly, 32% of Americans had outstanding housing payments at the beginning of August. So this is 1/3 of everyone who has a payment. So this doesn't include people who own their houses outright, obviously. This is people that have mortgages. This is people who pay rent. This is where we are at. 1/3 at the beginning of August still weren't making their payments. So this is pretty serious. The other thing that I want to come on to is the average debt to income ratio. So some of the things I'm going to talk about in this video I haven't spoken about before. I haven't taught you some of these things before. So this is some new data here, because if I just dump everything on you that I know, or the data that I use, I have hundreds of data points. And if I just dump all of this on you at once, it's going to be overwhelming and no one's going to watch these videos. So this is another thing we're going to bring in today, which is the average debt to income ratio. So there is a reason that we have crashes like this at 38. So this is 38%. It doesn't show percentage, but it is. It's 38%. And that is, we don't really want to go over that sort of level. 40% is extremely high. A good debt ratio is much lower, mid-20s, I would say, personally. So when we get to this sort of territory, of course, we had a housing crash. And where did it go down to? Well, it bottomed out at about 31% here in 2012. Now let's look at where it's gone over the years as we've gone through 2016, 17, 18. We don't have the data past 2018 right now, which is a real shame, because I would be very surprised if we weren't back at bubble territory where we had the crash before. So this in 2018 was at 37%. And remember, it was 38% when we had the last crash. And just to show you what I'm talking about here, actually, this is the US national debt now. It's almost at 27 trillion with a T. This is just unbelievable. This is so high. We've never seen debt like this ever in the history of our planet. Hi, if you're enjoying this video so far, I've just got one quick favor to ask. Could you please click the like button below? Just helps the video to actually get ranked, especially after I got in trouble with my video from last week. So any likes on the video would be appreciated this week. Why not subscribe to the channel? I bring videos like this to you every single week. And if you look at the GDP at 19.5 trillion, and we have a debt at almost 27 trillion, our debt to GDP ratio is over 100% now. And that is a big problem, because when you have debt to GDP over 100%, that is pretty serious. And let me just show you the rest of the world. It's not just the US that has a public debt to GDP or even an external debt. you go through and there's a lot more countries. Obviously, Japan has been in this huge debt crisis for a long time now. And if you look at their external debt to GDP, it's 91%. The US has 128%. It's scary stuff. The United Kingdom, we've just passed over 100% public debt to GDP, 284% external debt. France as well. As we go through, you can see a pattern emerging here. Greece in a massive crisis. Ireland, massive crisis. Surprisingly, you have countries like Nigeria that don't have a crisis. Their economy is just doing very well. They have a national debt of 121 billion versus a GDP of 500 billion. So you can see there's some countries that are doing a lot better than others. But let's just jump back then. So we were just talking about the average debt to income ratio. I just want to cover what is considered a good ratio. So if you're looking for a mortgage, lenders prefer to see a debt to income ratio smaller than 36%, but some will allow you to go higher than that. You can see here 43% is about the peak, I would say. However, the DTI, you can go to someone like Freddie or Fannie, and they will give you up to 50%. I'm not sure if it's mentioned here in this article, but they will give you as much as 50%, which is just crazy. Now, you might think, why would they be giving as much as 50%? Well, here's what's going on, which a lot of people are not aware of. The housing market in the USA is being propped up big time. And I have to show you the data, or otherwise you wouldn't believe me. People would just troll on this and say Neil is lying, he doesn't know what he's talking about. So I'm giving you the data directly from the Federal Reserve. So this is the asset sheet, securities held outright by the US Treasury securities right now. And look at this. So this was the last recession, 2008 recession. And you'd think, oh, okay, what's going on here? Not really a lot happening. And then we have these periods. Well, look what happened during this recession, this crisis that we've gone into. It's just skyrocketed up to 4.4. Okay, now just stick with me on this. Now, when we look at the assets, so these are the assets, these are MBS, which stands for mortgage-backed security. And this is when the Fed basically purchases your home mortgage. So they will purchase your mortgage. And look at this. Are you ready? The Fed have been on a purchasing spree. So 1.3 trillion before they held. They now hold just under 2 trillion US dollars worth of mortgages. Now, if you think the mortgage market is only about 10 trillion, that means that they're holding 20% of all mortgages right now. And remember, this is crucial because the Federal Reserve, remember this, is a private institution. It's not a government institution. It's privately held by shareholders. The Federal Reserve create money into existence out of thin air. They don't create, and it's not even money, it's currency actually. It's not backed by gold anymore. In 71, President Nixon took the US off the gold standard. So the crazy thing is, all of this currency is actually not backed by anything. So the Fed has just created money out of thin air, and they've purchased all of these mortgages. So 2 trillion of mortgages. Now, if that doesn't scare you, or you think that's a bit unusual, then I don't know what to say on that. But that's concerning. And I'm just going to read out actually something here. So this is regarding mortgage delinquency. So delinquencies are up 450%, which is crazy. Now, if you don't know what mortgage delinquencies are, let me just read the definition of it. So a delinquent mortgage is a home loan for which the borrower has failed to make payments as required in the loan documents. If the borrower can't bring the payments on a delinquent mortgage current within a certain time period, the lender may begin foreclosure proceedings. Now, that's quite crucial because what's happening at the moment is we are seeing a lot of foreclosures. They're up quite a lot. Now, the reason they're not up astronomical levels is because there's a huge backlog. The courts have been closed for a very long time, and there's mortgage forbearance. The forbearance program is the numbers are eye-watering. The number of people in forbearance, and it's not getting that much better. you might think things are really improving, but they're really not. I don't want to get too technical with it, but 50% of the people that entered forbearance are still in forbearance with no end in sight. Another 25% on top of that are trying to make payments and things like that. And then you have 25% who have paid it off, or they've got or they've come up with an arrangement with the lender, or worst case, they've now gone into foreclosure. So there's a lot going on, and they are fairly accurate percentages. I know it probably seems like I made that up, 50%, 25%, but we're only 1 or 2% out on those percentages. Now the other chart I want to show you is the HPI, which is the home price to income ratio. Now this is US and UK, which is quite good actually that they've combined this, because it really helps. You can see when we had the last crash, so in fact this was even before the crash. That's the unusual thing about this. So it's 4.64 was the peak, and that was November of 2005. Now the interesting thing about this is if we go to the November 2005, which is just there, home prices hadn't actually peaked at that point. They were still 17967. They didn't peak until a little bit later, so you still had a few percentage points in it at that point. So actually this 4.64, and it sort of normalized around 3.2, I would say around 3.2. And if we go back throughout history, you can see about 3, the level here, about 3 up to 3.2, I would say is about normal. But 3 would be a good level, and we got up to 4.6 here when we went in, just before we went into the crash. Now, right now, if you look at where we are, we're at 3.8, which is way above, if you were to look at it on a scale here, it's way above bubble territory again. Combined with this, what are we having right now? I still think we're probably going to see something similar to stagflation, something similar to deflation initially, and then inflation later on, as all of the stimulus and QE, quantitative easing, catches up with us. And we only need to look at Redfin and see these sort of headlines. Seemingly invincible, the housing market posts more strong gains, pending sales up 20%, prices up 11%. And that is true to some extent. Pending sales are up massively. It's ridiculous. Prices are up as well. But this is not going to last. I know everyone's saying it's going to keep going up and up and up. It will not last. I'm a student of history, of economic history. All I do is I go back and I look at what has happened. I track previous bubbles and crashes, and that's all I've done with this. I'm putting all the data together, again, hundreds of data points to get this forecast that I've made. And let me just cover that question as well, because people keep asking, well, has your forecast changed then based on all of this stimulus and things like that? My answer is I don't want to make a change to my forecast just yet until I see what's happening, because yes, some things are pushing the date back, but other things are pulling the timeline forward, such as the unemployment and forbearance. Certain things are pulling it forward, whilst yes, other things are pushing it back. So I want to hold out a little bit. I'm not like a lot of YouTubers who just now they're jumping off the bandwagon and they're saying, oh no, there's not going to be a crash. They change their mind every few weeks because they haven't got the confidence to stick by their data. Whereas I do have the confidence in my data. I've done the work. I've done the work over years and years and years. I've tracked all of this. I've spent a ridiculous amount of time, won't go into it, studying all this stuff. And when we look at some of these key takeaways here, this is the scary thing. I mean, they're making it out like it's a positive thing, but it's not. This is not positive. You never want to have bubbles and extremely high and fast growth. I remember when we had this back in 2005 to 2007, and I didn't know back then that this was actually a negative. I thought it was very positive, but it's not. When you have increases like this, 11%, this is not good. So just to explain these lines then and what's actually happening here, this is pretty standard, pretty normal from sort of February, March time that you have the upwards growth, and it goes on until about July. This is pretty much seasonal, standard for the housing market. And again, we had something similar this year through to mid-March when it really went a little bit crazy. right through to mid-April as we went into May. And then we had this drop-off. So this is where we had the drop-off, which was unusual. We haven't really ever had that before. This is purely due to the lockdown that was enforced. But then what's happened is this upwards climb, where it would have ended in July, has run right through to August and into September. We're still in this right now. So that's really why it looks very different to normal. The other thing to look at is the 4-week average as well. So again, pretty standard. You can see if you look back over the years, it's pretty standard, except the 2008 crisis when we had the housing crash, but pretty normal. But then we had this dip, and again, you can see it tracks the lockdown, and now it's just kept going up. Houses are selling extremely quickly at the moment. So just to show you another graph then, this is, we're still on Redfin, we're in the data center now. This is the other reason that house prices have gone up very rapidly, because again, you can see the blue and gray, this is 2018, 2019 years. The red line is 2020. Because of the lockdown, the number of new listings that hit the market went into a free fall. So you can see it actually went down minus 43%. So when you have new listings down, it basically means there's less properties or less houses on the market to buy. And when you have less houses to buy on the market, it pushes up the price because you've still got a lot of buyers. And I would say, if anything, we had more buyers now because people were in the lockdown, they decided they didn't like their houses, things like that. They wanted to move into new housing. And this created this frenzy that's still going on right now. We're still having some bidding wars. The other thing I want to show you is the off-market in 2 weeks percentage. You can see, again, we have this huge trajectory here. So within listing, so this is just the US as a whole, within listing the property, the house, so half of all houses are off the market within 2 weeks of listing. If this isn't a buying frenzy, I don't know what is. And really the simple explanation for these incredibly high prices, so you can see median sale price, 319,000 with a 13% year-over-year rise, is quite simply low supply. That's really what it's come down to. There's been an increased demand, there's been a decreased supply, plus extremely low interest rates as well. We've never seen interest rates this low before. So this is the other thing that's contributing. It really is the perfect storm. It's created the perfect bubble for high home prices. And if you've been following me for a long time, you'll know that I've said, do not get involved in this. Don't get into bidding wars. Don't be buying a house right now unless you're fixing in for, let's say, 2%, 2.5% over 30 years, and you don't intend to move from that house, that's your dream home, you're gonna stay there, then yeah, okay, why not purchase it? Because if there is a crash next year, well, it doesn't really matter because you're not gonna be moving anyway. You've got a 2%, 2.5% rate, so it doesn't really matter. However, if you locked in, say, a 5-year rate and it was 2.5%, 3%, and then in 5 years, the interest rates start going up 1%, 2%, 3%, 4%. If you remember the DTI ratio I was talking about, if you've maxed yourself out and you've taken on too much debt, then there's no way that you're going to be able to afford the house payment. So you've just got to bear these things in mind. Now, this is the data that I was really, really excited to show you because a lot of people were calling me out on my data and saying I was incorrect. People are not having this mass exodus from New York and LA and things like that. And I said, well, I'm 100% sure they are leaving in mass exodus, but we didn't have the data then. It hadn't been collected yet. The way I got my data was phoning moving companies, finding out that way, looking at U-Hauls and things like that. I was looking at that sort of data which hadn't been collated yet. Now it has been collated, we have the data, and you can see actually from this chart what is happening now. So we are seeing a movement from New York to Washington DC, to Philadelphia, very heavy, Boston, Atlanta. This is where people are moving from, leaving New York. And then we have LA, people leaving LA going to Phoenix. A lot of people going to Phoenix. Las Vegas. This is the reason Las Vegas housing isn't crashing right now. if it wasn't for a lot of the movement, especially from LA, Las Vegas housing would already be on the downward spiral, and it still will. I still think Las Vegas is going to be coming down. And in fact, I made some notes. Let me just cover some of the areas I think we're going to be seeing some issues in the future. I think New York, New Jersey area, we're going to see prices coming down. Florida, Nevada, and possibly Hawaii as well. I know that might sound a strange one, but that's what my data's showing. It's showing Hawaii may have an issue as well. More specifically, we have the New York to Newark. We're having a mass exodus of tenants. That will help to pull the prices down as well. Miami, a lot of apartments in Miami, a lot of empty apartments in Miami, a lot of people leaving. Orlando, entertainment jobs crashing. Tens of thousands either furloughed or laid off. A lot of these jobs will not be coming back due to employment scarring. If you don't know what employment scarring is, maybe just watch my video on that where I talked about employment scarring. It will explain that. A lot of these jobs won't come back. Las Vegas, the entertainment industry has imploded there with, again, tens of thousands of jobs having been lost. So they are my predictions on where I see house prices coming down as well. Seattle as well, people leaving Seattle. Now, the interesting thing is that this isn't yet shown in the data. Although people are leaving these places, it isn't being shown in the data. Let me just pull up something. So let's look at Las Vegas here. You can see Las Vegas is still a seller's market. We're not seeing any issues with this yet, because let's look at the inventory. In fact, we've got the listing price here. We'll look at listing price, and it is going up. We're seeing an increase in listing price. And this again, let's look at the inventory. So the inventory is extremely low because people are leaving LA and California, and they're buying in Las Vegas. So this is another reason that the inventory is low, and it's keeping prices high. So if you look at the comparison, so we have it there, you can see it's almost a direct correlation between the two. Just pulling up New York now then. Now New York is different. It's very different to LA, to Las Vegas, etc. And you can see it is a buyer's market, 22 points. It is still a slight buyer's advantage there. And if we look at the list prices here, you can see this. The list prices are just going down and down and down and down. 8.3 is the average, whereas before, I mean, look where we were before. It has just, this is really a crash. If you look at it year on year from 2017, where we're at 12.3, and now we're down 8.4, we're almost down a third. This is what I would consider a crash. We're already seeing 35% down. Now, if we look at the inventory, you can see inventory is going up. Why do you think inventory is going up? It's because people are leaving the city. They're leaving the city, and a lot of landlords, and this is you've got two problems here. You have landlords with empty properties, and you have people who are getting out of the city and they're buying in the suburbs. So as we come into the conclusion then, the other thing to bear in mind is a lot of the money that's being moved at the moment, which a lot of these organizations are using as their metrics, a lot of this is refinancing. It's not people buying new homes or moving home. A lot of it very heavily is in refinancing. Okay, so this is what they're not saying to you. The media isn't saying this as well. The thing with refinancing is, as I mentioned before, it's very positive for you because you can get a lower rate right now. The one thing I would advise you against doing is what I'm seeing a lot of people doing is they're saying, oh, my house has gone up in value, and quite dramatically. So let's, honey, let's get take out more money, and then we'll put it in our savings and things like that. The savings rate across the country is going up very, very dramatically at the moment. And if you look at the correlation between that and the refinancing, they match pretty closely. It's only about 70%, or should I say 30% out from that. So I think that's what a lot of people are doing. Now, the thing to bear in mind with that is that we have inflation. And Currently it isn't very high, but if we do start to have inflation, you think, well, I'm pulling this money out and I'm putting it in a savings account. Well, that's not always good because inflation will eat away at that money. So just bear that in mind. And my advice is always don't take on more debt than you need to take on. So if you are refinancing, simply refinance. You don't need to pull out loads of extra money for a new car, a new boat, and all these ridiculous things, or the wink wink home improvements. We need the extra money for home improvements. You never use it for home improvements. I know. This is what I'm talking about. Just refinance your house and slowly but surely pay down the debt. This is the most important thing. Gradually pay down the debt. Don't be one of these people that just keeps refinancing, and then waste the money on liabilities and new cars and things like that. Because we are moving into an era now of not prosperity, but quite the opposite. And I can see this going on for several years. I wouldn't be surprised if we do enter a new period where we are on a downward slope until the middle of the decade, middle of even 2025, could even go on for longer. It all really depends on the Federal Reserve, what happens with the US dollar, what happens with as we move into more digital currencies as well. But there is a lot going on, and I hope today's video really helped you with the housing market, with any decisions that you're looking to make in the housing market. So thank you so much for watching today. Please click the like button if this video helped you. Subscribe to the channel, leave a comment, and I will see you next week for another video. Take care.